Hi, welcome to the valuation dashboard for the week ended the 20th of July. A lot of changes this week. We've downgraded our Australian equities exposure and put more into our international equities exposure, as you probably saw throughout the week. I won't go into too much detail there. The note was out last week. We've also cut some of our earnings forecast for the Australian market. Now, part of the reason for the switch was that we were expecting these earnings downgrades coming through over the next month, and we've started to see a few of those DJs and in effect Myer, as we've seen analysts certainly cutting their Myer forecasts, and some of the retailers, a number of the other retailers, smaller retailers as well. So despite that, though, we do think we're still in front of the curve on earnings downgrades. We are expecting earnings for 2013 to be about 15% below what consensus is currently forecasting. So it's a bit of a mixture of the 3 years, a little bit off 2010, a lot off 2011, and then a bit more off 2012. So we do think we've built into our forecast enough room for for earnings downgrade. So we're not actually changing our earnings forecasts for this market, for this target. What we are doing, though, is we are extending the time in which we're expecting the PE to normalise. So we're putting up. Got a note coming out today on the 21st, which will go into a lot more detail in terms of PEs and how we get to our numbers and all the different measures we're looking at. But the simple version is that we do believe 14 times is a sustainable long-term PE for the market to get back to, given where inflation is and given where interest rates are and Australia's place in the world. We do think that's a reasonable target to get to. What we have done, though, is we've flattened this curve, and this is where the forecast of how, when you do get back to that number, we were expecting that to come back a little bit steeper. We've now flattened that out, and we're expecting that to take a little bit longer than what we had factored into our forecasts before. So sticking with this EPS growth theme now, I've spoken a few times before about this, is that in looking at 2011 EPS growth, and focus on industrials, this red line, a year ago analysts were forecasting about 17-18%, and if you step back a little bit, just a month or two further, it was closer to 20%, and then right throughout the year we saw downgrades to those numbers till analysts are now looking for about a -1% EPS growth for industrials coming into this reporting season. Switching across to 2012, we see the opposite has occurred. So we've seen 2012 industrial EPS has been upgraded over that time, and now at 19%. Now, given the state of the Australian economy, especially the non-resource side of the economy, we don't think that's achievable at all, and that we're going to see a similar pattern where that number just edges down, or expecting actually a bit of a jump down over reporting season, but then to see that number edge down over the next year. So the obvious question is which are the companies which are vulnerable, and that's what we've put our chart of the week here. Now, what we've got is 2012 consensus EPS growth. Now, it's just industrial stocks, and what you see is each bar represents how many companies sit in each band. So at this end, we've got the stocks that are growing at the right-hand end, are growing at more than 99%. So Macmahon, Elders, QRN are growing up there, and Leighton. So a lot of those recovery stories from having a poorer year. At the other end of the spectrum, we've got stocks growing at less than -10%, so DJs, specific brands, a few others within that are down at that end. Now, the colours represent the different sectors that make up the industrials, which are intended to give you a bit of a look and highlight areas like this where we can see a whole grouping of these material stocks all growing at sort of 25 to 50%. Or we can see in this 15 to 20% band, we can see these are the consumer discretionary stocks, which generally you'd expect to, in a weak economy, not to perform that well. And so you can quite clearly see which of those light blue stocks popping up there that might have earnings that are subject to downgrades. And at the other end of the spectrum, the stocks that are probably a little bit safer is some of the healthcare stocks, the green ones, where we can see not huge growth rates factored in, but also a lot of those have some international exposure, which should provide a little bit of an offset to any Aussie dollar strength issues.